Sorry, guys. It looks like YouTube hates us again, but no, just kidding. Uh, Chris had a power outage. It looks like we got to get a new producer now. Sorry, something in my throat. Anywho, yeah, we were talking about pot coin because, like, I like to smoke pot, and finally, like, Q has been freed. I don't know if you guys know this, but I was on a ban of weed on this show, and the ban has been lifted. So
You took it all the way
just
to the
get
top.
ready. I mean, to be honest, at this point, the only thing stopping me from literally ripping weed right now live on air is YouTube and my parents because, again, I live with my parents at 29 years old. I'm
They don't
a
like the
fucking
smell,
loser.
right?
Dude, it's funny because it's gotten so bad to where, like, I now learn, like, I got to go check, like, the windows around because if I just go outside of my room and smoke a joint and, like, the window in my brother's room is open, the window in my mom's room is open, like, the whole house will reek. And then my parents are like, dude, come on. And I'll just be sitting there like, but I didn't smoke, I swear. Anyways, back to the actual conversation at hand. One thing that I've been trying to corner someone into having a conversation with me and Chris, unfortunately, that has now fallen onto your lap, is microbetting on the Lightning Network. Um, the concept itself is rooted from a lot of the sports books out in Europe. Live in-game bets make up, and micro bets in general make up over 60% of the bets that are made in the European markets. I've seen a lot of reports that the US markets are looking at ways to incorporate this, but it's just not ready to be rolled out at scale. I'd love to just talk to you about what you've seen and the stuff that you guys are working on. I know you mentioned that you guys are not yet there, but are working towards it. Would love just like your thoughts on betting on the Lightning Network.
Well, so there's like a couple like aspects to this, right? So, on the like bet setup side, yeah, we definitely want to get to the Lightning Network. We are believers at Surebits that on-chain fees are going to rise over the long term on the Bitcoin base chain, and eventually small DLCs aren't going to be possible on the Bitcoin blockchain. I think DLCs will always be possible for like whales, like a Sailor, a Bukele, or whatever they want to do with hedging their financial risk. Or maybe you're Mr. Novian and two for the money and you're betting millions of dollars on these games. There'll always be a place for you on the Bitcoin blockchain for that. However, if you're betting smaller amounts of money, like say $10 or $5, or betting on this like very short-lived event, like that you were mentioning, we have designed DLCs to be compatible with the Lightning Network so that we can lift DLCs up to layer 2. Once we have a couple upgrades to the Lightning Network, that should be possible now with Taproot. So we are waiting on the Lightning developers to change some technical details on the Lightning Network to achieve this. But that is definitely in our at the forefront of our mind, is lifting this stuff up to layer 2. This gives us a better user experience for everybody, since you don't got to deal with the Bitcoin blockchain slowness, fee related issues. And now you can just instantly set up a bet with somebody on the Lightning Network. Other things to consider, of course, is like more on the operational side of the sports book, of like, figuring out the risk management side of things, figuring out what events people want to bet on. But there's nothing that's like fundamentally not possible here, from the Bitcoin perspective. And it's just a matter of figuring out the right kind of market that can, I guess, have enough liquidity to make a profitable business off of that. It's super interesting to hear from you that you said 60% of the betting that's occurring in the European markets now
And
is.
so to
Go ahead.
categorize this, it's any bets, I believe the number was less than $5. And it's both categorized as like those small bets that are just made before a game starts, as well as an in match game. So, like, for example, will Arsenal score in the next 5 minutes, or will Tottenham end up giving up another goal in the next 15 minutes? Like the usual things that always happen in the EPL, right, Chris?
Yeah. Uh, I'm not sure which Chris you're referring to, but I'll
I,
take it
I
from
was
you.
making fun of producer Chris because Tottenham is full of assholes and bitches, and fuck, I can't believe Arsenal didn't make the UEFA Champions League.
Yeah. So like the other great thing that is aligned here with these micro bets in the Lightning Network is they can last for small periods of time. One of the limitations of DLCs on the Lightning Network is you need to tie up liquidity across the entire network for the duration of the bet. So maybe me and P are betting, but I'm not directly connected to P. So I'm routing through you, Q. That means like I need to set up the bet to you, and then you go and set up the bet to P. And then that liquidity is locked up until the bet expires. So if the bet is just 5 minutes, and like you were talking about with the Arsenal goal in the next 5 minutes, that's great. That means that bet set can settle relatively fast. But now imagine we were doing this election bet on the Lightning Network and we set it up in, I don't know, July, and the election is not till November. Well, that means that we've got to lock up your liquidity on the Lightning Network for 4 or 5 months. And that's a very long time where you could maybe be using that capital elsewhere for more productive things. So micro betting really does align nicely with layer 2 DLCs on the Lightning Network. And it can also has the potential to give this wonderful user experience and not be kind of this walled garden that we see in traditional sports books. So it's a very exciting frontier to explore. We just need some changes to the Lightning Network as it is today to be able to get there. And I think those will probably happen in the next year or so, is kind of the vibe that I'm getting from the Lightning developer folks.
Love it. I'm about to lose so many stats when this happens for nothing more than trying to be a degenerate gambler. What can I say? Ooh. P, 5 sats. Heads, tails.
I'll call it in the air. Heads. I can't see what that means.
This was heads.
Yeah.
5 sats.
5 sats your way, P.
Guys, I'm going to be rich.
1 sat at a time.
Generational wealth right there. Chris, for our audience who didn't have a chance to, we will be posting a link to the article that you wrote, but where can our audience stay up to date with some of the stuff that you and your team are cooking up?
Twitter.com/Surebits is one of the best ways to follow us. We have a Telegram channel. I think it's t.me/Surebits to join that channel. If you want to, do a DLC, like I mentioned earlier in this call, and you have an Umbrel node, that's the easiest way to do a DLC at the moment. Hit me up on Twitter, Chris_Stewart_5. We will be rolling out the DLC wallet to all desktop platforms the next month or month and a half, and then we look to get to mobile after that. We are solidifying. So if you're a Bitcoin developer and happen to come across this, discrete log contracts are an open source protocol that anybody can participate in or go and read how the protocol works. It's very similar to how the Lightning Network's an open source process. We don't claim to have a monopoly on this protocol, and we've got developers from all across the world working with us to build this protocol so it can be as applicable to as wide of use cases as we've talked about, some of which are on this call. So I think that's pretty much what I've got for Shilling.
Awesome, Chris. Well, thank you so much for taking the time to join us. We'll definitely be picking up this conversation, I'm sure, much sooner than you think. I really hope we do not just have another power outage, Chris.
No, did we? Let's pretend. Let's assume we didn't.
All right, assuming we didn't, be sure to give Chris a follow. Be sure to take a look at the article. Feel free to DM any of us to make a bet. And shout out to the Rumbler who wants to bet on how hot my mom is. You are a savage. That's all I got to say. Lock in your tickets to Bitcoin 2023 and use promo code FOMO. Get 10% off of everything in the Bitcoin Magazine store. We're going to cut to a quick commercial break, and we're going to be joined by the Bitcoin Magazine Pro team. And Dylan LeClair is going to talk to us, I guess, maybe. Who knows? Thank you, everyone who stuck through that very long commercial break on YouTube. For everyone tuning in over on Twitter Spaces, you can come pop over to YouTube. We will populate a link at the very top so you can come see all of our pretty faces and my very bad hair day going on right now. But it is now the men of the hour, none other than the leaders of Bitcoin Magazine Pro, Dylan, LeClair, and Sam Rule, joining us to give us some updates on what they're seeing out in the market. I'll let you guys take it away.
Guys, how we doing? Yeah, I mean, I think we're just going to be talking some Bitcoin markets like always. That's what we do. But in particular, I think we'll probably focus and dive a little bit on our latest writings on Bitcoin publicly traded miners. When's the best time to buy those? When's the best time to stay away? What that cycle's looking like. But we can dig into that in a little bit. Joined by my partner Sam Rule. How we doing, Sam?
Yo, what's up? You guys hear me okay? Sweet. Yeah. Hey, everyone. I'm Sam. If you haven't heard me speak before or seen some of the writings on BM Pro, but closely work with Dylan, been on BM Pro for doing this about 8-9 months now. Dylan started this back over a year ago, but yeah, pretty much cover everything from mining to macro to derivatives, on-chain, anything that touches Bitcoin market. So I think last month did a little bit of a state of Bitcoin mining and what it meant for returns and miners, things like that. So we can dig in a little bit more of that today.
Yeah, I mean, the last week or so we've covered, I mean, obviously Bitcoin, the asset, the native asset, the one that you can send to your cold storage is what I think is the most important to understand and to grasp and to hold. But, over the last 2 years, we've increasingly seen a bunch of Bitcoin-esque or, Bitcoin exposure type vehicles or securities come to market. No ETF yet, but whether it's, Grayscale, which has been around for a while, whether it's MicroStrategy or increasingly I think 20 or so publicly traded miners that offer, some Bitcoin-like exposure. And so, all of those names for the most part have been, gotten absolutely beat up since the top of the market. Bitcoin's probably done the least at around 55%. But for anyone that's interested, at the top of the space, we've pinned our latest Bitcoin Magazine Pro article or actually it was yesterday's, examining the publicly traded Bitcoin mining cycle, what drives it, and when's the right time to invest. Obviously, we like to take a data-driven approach, but it's better to be lucky than good a lot of the times. But really, I think we'll dive into this, but it's about hash price, and hash price is something that's pretty simple to understand once you kind of understand the mechanics of Bitcoin, hash rate difficulty. But for the average market participant that doesn't know those things too well, I guess we can probably dive in and explain it a little bit more. Q or Q, you wanna ask any questions, or
Let's just go ahead and start right there. Let's start more on the macro environment, and maybe talk a little bit about some of the most recent stuff you're seeing out of the Fed as well. We have a rate hike, I believe, in 4 weeks, or a Fed meeting in 4 weeks now, where they've come out and said no 75 basis point hike. Curious what you're noticing out of just public markets generally and the bond markets there.
Yeah, I mean, so we've been pretty consistent with our message. I think since early Q1, when the markets began to realize that inflation wasn't transitory. Well, I mean, the market kind of realized that in November, but bonds were, supposedly the smart money. The bond market was far behind the curve, and so the Treasury market, yields in the Treasury market, which is the global risk-free rate, started to really bend upwards, and long dated duration assets, whether it's equities, growth stocks, long dated bonds, got absolutely killed. And you can kind of think of that as like almost a flush of liquidity, right? As yields start to rise, you see just mark to market losses for assets around the world, Bitcoin included, especially a lot of the stuff in the broader crypto space. But since then, I think really the game is, for the past decade or 12 years, it was don't fight the Fed, buy the dip. And with this kind of regime change and inflation becoming completely unhinged, it's become, Powell's basically signaled to the market, it's essentially inflation has to come back down, or we're going to get it down for you by basically engineering a reverse wealth effect. For better or worse, the stock market is the U.S. and global economy. And so by kind of crushing and dampening asset prices, you can kind of squash demand somewhat and try to get that inflation year over year down. How long that takes is really anybody's guess. And, it is somewhat, it is kind of frustrating that the world we live in is dictated by an old guy in a suit. But that's the world we live in. And the dollar still is king, despite, the future that many of us think we're headed to. The dollar rules. And so in that sense, we still think, a recession is in the works, and it seems to be that consumer demand is slowing every day, partly because of this fall in asset prices. NASDAQ down 30%, S&P down 20%, Bitcoin down 50%. A lot of wealth has been destroyed, and so I guess maybe to not ramble for too long, I think that's what we've been kind of looking at, and I think that's rather unchanged since the last time we talked last week.
Yeah, I mean, it's definitely a thesis hit on a lot in terms of where we shifted from like post kind of Bitcoin halving cycle, seeing this run up in risk assets across the board, and then shifting to saying, okay, the data now showing that you're going to have this growth deceleration, you're going to have this liquidity deceleration that, Dylan alluded to there. And so, one chart you could look at anything right now is just don't fight the Fed over the last 10 years and looking at like central bank balance sheet asset growth across the last decade. And you look at that across the Fed, the ECB, Bank of Japan, even People's Bank of China. And then what you see is like a huge reversal in that. And then you could pull up any tech stock or equity index with that, and you're going to see the same thing as the liquidity is pulling out. That's happening at the same time. You guys did a spaces with Darius Dale from 42 Macro, and he does a lot of great research on talking about not only the market regimes that you're in and you're shifting from, but the business cycle, corporate earnings cycle, which is starting to shift as well. I saw that with some of the stuff. You could see that in like Target and Walmart, huge earnings misses there. And now the name of the game, pretty much like demand destruction. like Dylan mentioned, from the Fed. And so you're starting to see that in some of the data. There's a lot of different data points you can look at from the economic cycle of where things are headed. Just recently saw huge decline, 29% annualized drop in new home sales month over month. So that was a huge miss. And so you've seen that with essentially JD Power came out, auto sales, new sales coming out for the next month, saying those are going to be down, essentially 21%, maybe in line with earnings a little bit. You've seen growth come down. So you're seeing even you think of like PMI, which is more manufacturing index data across countries, is all decelerating at the same time. So basically, this was something that we were trying to think ahead of in some of the macroeconomic research we were looking at the beginning of the year, also looking at the impact on credit deleveraging and rising of credit spreads. And if you look at any kind of back test or performance through risk assets, it's always been, a terrible time. And it's really 2022 is like a turning point for that. But just recently on the Fed, I think to cue your question more specifically, they came out with some minutes today where they've pretty much, trying to commit to the stability of saying rising 50 basis point rate hikes for the next few meetings, trying to tighten conditions, and even going out to say that financial tightening conditions are going to last through 2023 and 2024, basically not projecting any QE, but opening the door and saying, okay, by the time we do this, hiking rates for a few more quarters or months, or at least to the next few meetings, that leaves them with this accommodated policy potential where opening the door back up to kind of this dovish pivot QE. So that was the latest. I think saw that on that coming out today.
I've heard a lot lately, especially with Bitcoin, basically, trading as a, the Bitcoin 100 or the Bitcoin 500, basically, exactly following these massive US equity indices, that it's just another Wall Street, risk asset. It's been completely kind of neutralized or financialized, and it's kind of, it's over, right? But I think the reality is if you were, seeing this new global decentralized money arise from zero, from scratch, right? As a group, bigger and bigger and bigger in value and liquidity and market cap, I would expect it to act as basically a pure kind of reflection or alarm signal of the risk on, risk off of the legacy system, of the credit contraction or credit expansion of the legacy system. And that's what we're seeing, right? Like when the Nasdaq's dropping, 30%, what that's telling you, essentially, you can think of that as a dollar in purchasing power terms rising 30% or whatever, the equal math is there, right? So I think this is nothing unexpected. And if you look at just the last time there was a crash in the equity indices, the last time there was a risk off moment, the last time the VIX, the volatility index and legacy market exploded, Bitcoin was 8,000, went down to 4,000. So at 29,000 and people are saying the world's over. Yes, there's a whole lot of people that came in 2021 that are underwater or sitting on a bunch of unrealized losses. But in Bitcoin's history, that's completely normal, right? I mean, it's seen 80% drawdowns at 55, 60% here, whatever that is. This is just kind of another monetization cycle. And the interesting thing is we're still above the average cost basis of all, of the users on the network. We call that the realized price, which is around 24, 25,000. And in every bear market previously, we've dipped below that. So it's not saying that we get there, but in terms of the Bitcoin cycle, yeah, it's a lot bigger, an order of magnitude bigger. Yeah, it's more financialized than it's ever been. But in terms of Bitcoin's kind of monetization, this is nothing out of the ordinary. And the volatility to the upside and downside is the price you pay for, huge returns over the long run.
Yeah, to your point too, I think there's a lot of macro research people out there kind of like outside the Bitcoin lens that I do respect, and they may not have a pro Bitcoin stance, but they come at it from like a liquidity market stance of saying that like I've seen liquidity lottery. I've seen that like Bitcoin has just been this benefit of this speculative bubble rise. And that's certainly the case. It has benefited from that. But you see like very little critiques, and to also coming at it from like an adoption and a network standing perspective, and looking at some of the holding metrics and looking at just being within kind of in the space all the time. I think you see stuff that people write off and they just want to say that Bitcoin is basically this speculative bubble, and it's just a reflection of all of that in one, which I would probably say the crypto market is more than that. But to Dylan's point, the fact that we haven't even seen it go below the network cost basis yet, and severely, even though this is on the rise, is a good sign. Although I do think the base case is it will go below that. It's done that multiple times through its history, and then have lasted there for a few months and times in terms of this bear market cycle period. So far, with its network effects and kind of its fundamentals, we haven't seen anything out of the ordinary yet for the asset. That said, too, S&P is only down 17% from all-time high. And if you're looking at like a pretty rough kind of median drawdown in more of a recessionary period or large growth liquidity slowdown, then, more of that median peak to trough drawdown is like 30-40%. So base case is still, at least in my mind, worse is yet to come. But I think it's a lot more nuanced and kind of naive to write off Bitcoin as just a popping of a speculative bubble and nothing else behind it.
I think it's also pretty interesting. We covered the kind of the huge volume spike, the spot volume that when Bitcoin kind of post Terra Luna crash, Tether was briefly depegged. It was kind of just a broad crypto Bitcoin market panic. We saw, wick to 25.5 or something on Coinbase, and it's just a gross de-risking across crypto funds, for better or worse. And so I think these are the type of events to play devil's advocate to our bear bias that we've had, or kind of cautious signaling since early Q1. It's these are the type of crypto native events. At least you see a ton of coins trade hands, these high volume moments at tops and bottoms, where bottoms are made. So I think if legacy markets, we may be in the middle of or the beginning stages of a bear market rally. I certainly don't think that the worst is over in legacy markets. But from a pure Bitcoin standpoint, I think if we start to see the next leg of equity market capitulation or sell off, I think a lot of the spot sellers that would be there have already sold. And interestingly enough, those correlation traders, whether they're trading futures or not, I think probably a lot of the selling would come from the derivative side of things. And that's when you kind of get potential for these, juicy short squeezes where, a lot of people are forced to cover. And that's when, I'm not saying it's going to happen, just situation. That's where kind of these decoupling events happen, is where, most of that, spot inventory, those natural sellers, the equity market correlation traders have already kind of unloaded all their inventory. And now, Bitcoin would decorrelate because, anybody that's still left in the market and being major sellers is doing it via futures that at some point they have to cover. So, that's what we're looking for, especially from the derivative side of things. And we haven't really seen that play out yet, but, that's probably, in my opinion, what it would look like when the correlation kind of eventually did, break, right? Like people don't really realize that in March 2020, Bitcoin was 40% off the lows before or the day that the equity markets bottomed. So that's quite a decoupling or decorrelation, and I don't think we're there yet. And I don't know if the panic will be as fierce and the volatility will be as fierce as it was during that period. I don't think so, because I don't think we're going to see global lockdowns again. But who knows? I think it's just worth keeping that in mind.
Unless there's anything else either of you guys wanted to touch on, I'd love to dive into your most recent report, where you guys really broke down the Bitcoin miners. Cool. So I want to read a couple of bullet points, specifically the fact that there's been a roughly 7% month over month increase for how much Bitcoin these publicly traded miners are holding. And you introduce a little caveat to this, that this data is pre-Bitcoin's market fall from $40,000. So the next month of data updates will be key to see if top public miners are scaling down their Bitcoin holdings or hash rate in response. I'm curious if the two of you can just expand on this, like why would they, what's the rationale here, understanding like the cost per hash rate and the cost per Bitcoin is going into this equation. I'm curious where your guys' head is at though.
Yeah, I can expand on this a little bit more. So, I mean, I think the prevailing trend talked about a lot. I mean, if you're looking at any of the Bitcoin miners, public miners at all, I mean, what you've seen nearly over the last 6 months is just kind of a rush to build up Bitcoin treasuries as a response to their bullishness on Bitcoin as a whole, to not wanting to sell that if they don't have to cover cost. Also responds to having cheaper access to capital markets in terms of debt and equity. Some of that is going away as well. Also just to attract shareholders as well. So this is, essentially we talked about how out there right now in the US, you don't have a spot Bitcoin ETF. You have the BIDO futures ETF, which so far in a downward market has only underperformed Bitcoin by a couple of percent, but in a bullish market, it's much more likely to underperform. So just having access to Bitcoin investment vehicles, having that as a treasury has been just really a strategy that almost every public Bitcoin miner has taken upon. There's really only a few that either from an operational decision or capital decision hasn't really done that. So when we pull this data, this stuff comes out pretty much first week of every month. You'll see miners come out with monthly production updates. And so far that's been a growing trend. So 7% another month on month, building that is pretty impressive. Now, where we get now into kind of a more bear market cycle with price and mining overall, although I would caveat and say most public miners have a pretty low break-even cost in terms of what would stop them turning on machines, because they have a lot more efficient mining machines. That's somewhere between like $6,000 to $10,000, $12,000. So, but now you get to a point where even Core Scientific over the last month basically said, hey, they were projecting out their hash rate to be 40 to 42 exahash, huge. One of the biggest miners in North America, one of the biggest in the world in terms of capacity to do hosting and self-mining. And then lately they came out and scaled that back down and brought that down to like 30 to 32 exahash. And they kind of said that that's a result of capital markets right now as well, right? So it makes sense to scale out production and to try to be aggressive on that when capital is cheaper, and not so much when things are tightening and when pricing pressure is coming down and your margins are getting more squeezed. So just in terms of that accumulation trend, which seems to be a long-term trend for miners that don't have too much, I guess, margin loans that are collateral with Bitcoin or their machines and can like building that. But I mean, this was not always the case for miners. It was essentially, you sell lots of Bitcoin to make profit for your business. And that's just how it goes. And you weren't able to necessarily keep the balances that these treasuries have done before. So it's just going to be an interesting dynamic as we go into what looks like more of if price even forms right now and stays around 29,000 for, let's say, a couple months, or we chop around or we go a little bit lower. This is, it's much lower than kind of the projections and revenue that miners were making over the last year, kind of in a golden period of mining. So I think we'll get these in about, probably about a week, 2 weeks, these will start rolling out. And so we'll just get the first signs of like public miners are probably some of the least likely at risk, although there's some out there that, depending on how much debt they have, that, potentially likely to not necessarily reach default, but get into more kind of capitulation territory, even if that means selling some of their machines. But we're going to get to see like some of that for the first time of like, is this larger trend going to reverse? Or these miners that we're tracking in here, I think we've got about 12 public miners, which is not necessarily all of the industry, but they make up about, if you use the hash rate numbers just recently, they make about 18 to 20% of hash rate. So pretty significant. So we're going to start seeing for the first time, if they start rolling back on this trend, if they start selling off some of this Bitcoin, if there's more selling pressure on the market. We haven't necessarily seen that yet. But then again, if prices kind of stagnate down here, it's margins are getting squeezed for sure. And, some of these miners haven't been through necessarily a bear cycle before. A lot of these big public miners are coming out and growing over the last 2 years into the bull cycle. So it'll be interesting to see across the board if we're scaling down in terms of production plans, or if they're selling off Bitcoin on the treasuries.
Yeah, I think there's a couple of interesting things to think about when you're looking at Bitcoin mining and to understand, right? So most commodities, and I think Satoshi has a great quote, and I might miss it by a little bit, but it's like the price of any commodity trends towards its marginal production cost. And most every commodity in the world, really every single commodity, it didn't have one absolute scarcity or supply inelasticity, right? So the price of gold or the price of wheat or the price of maybe not wheat, but the price of oil goes up by a factor of 10, there's a lot larger incentive to do that. And through some CapEx, eventually, greater supply will be brought to the market, and that price will be, hammered down until there's, some sort of equilibrium is found. Well, Bitcoin has a perfectly inelastic supply issuance, right? So around 900 Bitcoin a day, 6.25 Bitcoin every block, approximately coming in at every 10 minutes until the next halving event. What matters for miners, right, is that especially if you're valuing these companies in BTC terms, which you should be, right? There's no point in buying a Bitcoin miner, whether it's an ASIC or whether it's an equity. If you're not doing the ROI in BTC terms, you have to understand that basically that revenue stream is going to be cut in half around every 4 years, and eventually, the fee market will be predominantly, and it'll be 100% of that revenue. So what you have to understand is that as hash rate rises, your Bitcoin revenue, because of the difficulty adjustment, which ratchets up or down depending on how fast or slow these blocks come in, perfectly adjusts and keeps that supply inelastic. So as hash rate has risen from, I think it was 180 pre-China mining ban, 180 exahash. I forget what the lows were. I could probably look at right now on my screen here, but right now it's around 210. And so what you're seeing is that 900 Bitcoin are still coming in per day. The price of Bitcoin has fallen a lot, but if you're valuing in BTC terms and the hash rate continues to go up, you're getting marginally less Satoshis per unit of hash. So this is where hash price comes in, right? Which is your miner revenue, your daily miner revenue. And you can do this in USD or BTC terms, divided by your hash rate. And in the secular trend is that hash price is going down, like exponential decay. It's down 99.999%. And if you look at really any period, you need a logarithmic scale to look at it because it's down so much. So what does that mean? It means that, you're getting per marginal unit of hash, you're getting less Satoshis or less dollars, right, per revenue. So when's the best time to buy a miner? Well, whether it's an ASIC or it's a publicly traded equity, you want to buy miners during hash price bull markets. So that's when the price of Bitcoin is rising faster than the hash rate. That's where the real money is made, and that's where these publicly traded miners that are trading at equity multiples really explode, and they see their margins explode as well. And so if you want to see what we're talking about in more depth too with some visuals, look at the top pinned tweet. I think it's the one on the far right. It's the article we wrote yesterday. But essentially, if you map the bottom of hash price in 2020 to the top of hash price in 2021, and then look at the miner returns, these publicly traded miners in BTC terms, Marathon, Riot, and Hut were up 318%, 207%, and 62% in BTC terms, as hash price went from 8 cents to 42 cents. From the top of hash price to the bottom to where we are today, 42 cents to around 11 cents per terahash. I'm sorry. You see that these publicly traded miners are down 55%, 59%, and 62% in BTC terms, right? So they act like beta, but there's a reason why, and it's mostly because of this hash price dynamic. There's obviously an oversimplification here, the management team, just the execution risk, all of that, but that's essentially what's at play.
Break this down a little bit more about the I'm trying to make sure I'm saying it correctly, like the hash price bull market and the hash price bear market, because I thought this was an interesting analysis that you guys introduced, where there are opportune times to go into the miners, and yet there are also better times to just be focused on actually stacking sats. I'm curious, though, not from the lens of an individual investor, but rather from the lens of one of these miners taking this analysis or taking these formulas. What, either of you can be the CEO of your favorite Bitcoin miner for this experiment or this thought experiment. Like, would this affect or change your approach as an industrial miner if you are seeing a hash price bear market?
Yeah, so I mean, there's a few things. One is that the debt financing aspect definitely changes the dynamic a little bit. It changes that calculation because you have to, if you sell Bitcoin to buy these miners or to invest in a new mining facility or whatever it is, you have to, along with all the tax burdens associated with selling that, you have to ROI, you have to positive ROI in BTC terms. That's pretty tough. Throughout the course of Bitcoin's history, that's been proven to be pretty hard. But if you can collateralize some of that Bitcoin, don't overextend yourself to where you are forced to become a seller, or you get margin called, and you can access USD denominated capital at a maybe a 5% rate, a 7% rate. That ROI is different. And a lot of these publicly traded miners, again, their cost basis, their production cost is 8,000, 10,000, 12,000, 14,000. So they have a long way to go. Like hash rate can still double, and they'll still be profitable mining Bitcoin, but just not so much, right? Their margins, some of these miner margins are still pretty ridiculous. I don't have exact numbers here for you, but they're still deep in the money. And so during bull markets, those margins are the ones that explode, and that's when you see that positive ROI in BTC terms, right? So when hash price goes down by 75%, all the miners get killed. Never mind the fact that they have dollar denominated debt on their balance sheet. They're basically leveraged long Bitcoin or Bitcoin derivative, because of these ASICs are essentially Bitcoin producing machines, right? So there's a pretty interesting dynamic there. We're not suggesting to go out and buy miners now, but relatively, these are the conditions where hash rate, really grinds up, their valuations get killed. And, I think some of these names where, they have Bitcoin holdings, their balance sheets are pretty much denominated in Bitcoin. Maybe they don't have much debt. When hash rate continues to climb up like this, I think some of these earnings ratios, earnings multiples on these mining firms in BTC terms, and you have to anticipate stuff like future halving events. And there is a little bit of uncertainty with how high hash rate can go, right? How competitive they can stay and their market share. But they have earnings ratios or earnings multiples around 2 or 3, right? So compare that to other markets in publicly traded equities where they're 15, 20, right? So I don't think we're there yet. Don't go all in on miners, right? Have a nice BTC stack, but there will be another opportunity and another run where these miners vastly outperform Bitcoin itself. And we want to help potentially inform anyone that's willing to listen about what these dynamics look like and maybe how to capitalize for yourself.
And just as a quick reminder to everyone, sorry to cut you off, Sam. Everyone on Twitter Spaces, we're not going to be taking guests up. Come join us over on YouTube. The link is the middle link that is posted. And of course, if you are not yet subscribed to Bitcoin Magazine Pro, be sure to click the link. I believe it's all the way. If you swipe to the left, you can get a free 30-day trial. You can actually get the deeper analysis that the two of them are talking about. I'm going to stop talking. Sam, back to you.
No, you're good. I mean, the only thing to your question, the only thing I'd add to Dylan's point there is when you're thinking of okay, what do you do in the golden area? And when your revenues are high and your hash price is high and your margins are higher, I think it's probably what every larger miner, whether you're looking at Riot or Marathon or Core Scientific, across the board, is just trying to expand and take up as much hash rate share as possible. So using a lot of that capital mixed with the debt financing capital they get by holding some of that Bitcoin when they're not forced to sell to upgrade their fleets, getting the most efficient machines they can. I mean, working on things like Riot building out essentially their immersion cooling technology, building out all sorts of production facilities, these 400 megawatt type facilities that are being built out now, and using that capital in that way, because when it comes in bear market time, essentially, you take all that capital in bull market and you try to invest in your business that can be efficient on the margin as possible down the road, because of how hyper competitive the industry as a whole. So a lot of that we're seeing today too. And just from plans from last year, stemming into 2022 as meant to be this kind of incredible expansion plan, really miners growing into the likes of scaling facilities that we've never seen before. That said, at the same time too, when you're in a position like that and you have the post-China mining ban and you have all these rigs hitting the market at low prices, as long as you have the power capacity to plug some of these in, which is a little bit of an issue now in the market of having machines on hand but not being able to get them into capacity, so going through those build outs. But you want that capital on hand that where you can go out and acquire those things. And so now we're getting to a point too, where maybe not necessarily some of the larger miners are going to face some capitulation, potentially maybe some larger industry scale, but you're getting these lower prices and kind of break even for certain levels of machines. So if you think of S9 machines probably make about 25% of the network, you're getting to a point where some of these are getting below their break-even price, where kind of difficulty is today, where hash rate is today, where hash price is, and also price itself. So essentially, you want to try to avoid any capitulation events and try to expand out and build your hash rate share as much as possible when those times are good.
I think it's also, it's interesting the kind of the cyclicality of these, especially the publicly traded miners. I mean, you see it with ASICs as well, but not so much, given that, they're mostly, I mean, if you're plugging in ASICs, you are pretty experienced. If you're buying these, at scale, you're doing the ROI calculations. But I've noticed that specifically with the public mining markets, public equities, in bear markets, in BTC terms, a lot of times they look like a really, really good deal, and oftentimes they are. The valuations get absolutely beat to all hell. And during bull markets, like Wall Street comes in, and in USD terms, you put a multiple on it, they look like fair value. But in BTC terms, especially when you kind of understand the halving dynamics, and you understand, these hash price bull markets and bear markets, you kind of come to realize that they're far overpriced in actual BTC terms. If you run revenue, run earnings, just look at the balance sheet. And so I think, the opportunity is, having that edge, evaluating in BTC terms. And that's for really any publicly traded equity. If you believe in Bitcoin long-term, right? When Coinbase IPO'd, for example, obviously not a miner, but Coinbase IPO'd, I forget its dollar valuation, but I remember shaking my head saying, there's no way Coinbase is worth 2.5 million Bitcoin. So if you have a Bitcoin focus and you're investing in public markets, these are the calculations that you should be running, whether it's back of napkin math or just, diving in really deep. Understand that, if this thing I'm buying is the future, and I believe in it, and it's, going to be at some point global money, or whatever your kind of framework is for value in Bitcoin long-term, is this, equity that I'm buying worth its fair value in BTC terms? And if not, then, maybe you shouldn't buy it, or even maybe you should short it. I'm not recommending you do anything with securities, not financial advice, but yeah.
Throughout the course of our conversations that we've been having here for some months now, Sam, I still remember when you brought up how, these miners at the new year had very lofty goals for themselves, and yet, supply chain issues and the semiconductor shortage could very well be a hurdle for them to have to go over. And now we're seeing the cost of capital rise. I'm curious if, there are other things like a rising unemployment number or a full-blown recession and GDP going to negative, if these type of numbers or figures will have any impact on the way Bitcoin miners operate, or if just strictly the cost of capital getting more and more expensive as interest rates go up will be the biggest factor inhibiting their growth right now.
Yeah, it's a good question. I haven't given that a lot of thought into maybe it's external, like recession factors and what that might mean for miners. Obviously, seen from miners themselves, cost of capital being a limiting factor in terms of expansion. So that's a huge one. Also, just thinking in terms of lower revenues, lower margins getting squeezed will be important as well. But in terms of like recessionary numbers of like saying, how is that going to impact larger miners? I'd say maybe there's probably a lot in the mining space. I've done a lot more digging in this than I have in terms of the purchasing power agreements for electricity prices. But certainly now you're going to have an issue of rising energy prices. They're going to be revisited. So maybe when contracts are being refreshed or being re-signed, and looking at new energy prices and energy hedging costs, they're going to be at play. I think most miners now are operating at somewhere between 4 cents to 6 cents kind of a kilowatt, depending on kind of their deployments and where they're at. So that could be another factor. I mean, if you're going to have this more of a sticky inflation coming in and possibly rising with hosting costs as well, that maybe some upward cost pressures that are likely the biggest to come out of this, because I don't see right now, in terms of what I heard in macro energy analysis, anything that's going to come down soon or stabilize. If anything, it's going to be a more volatile market, and likely those that can hedge their prices, their contract prices of electricity, and be able to manage that and execution risk are probably going to be ones that have a better time over the next couple of years.
I know that some of these publicly traded miners, I went to a mining conference in Austin in the summer, and the talk was that everybody wants to get in, but actually, scaling these operations, getting them plugged in, never mind the ASICs, but the generators, building out these facilities, along with kind of the supply chain disruptions that you're seeing in the global economy, is just so challenging. I knew, I think Marathon had like 3 or 4 exahash just sitting on pallets because they couldn't plug them in. So it's one thing to, raise capital, which a lot of these miners did. It's another thing to buy a bunch of ASICs, especially post China mining ban, when there was kind of somewhat of a fire sale. It's another thing to actually get these miners, to get these ASICs plugged in and have the operations run smoothly, right? So there's, you can do a whole lot of things on paper and forecast all you want, but it's extremely tough and super competitive to actually do it at an efficient rate. And so I think that's where, it goes from less of like a data projection kind of numbers game to more so how competent is your management team, how competent is your engineers, and that's something where it's more about individual names at that point, and kind of under promising and over delivering, and we'll see what are those names are. I'm not here to offer stock picking advice, but that's what's going to weed out the names that probably get over leverage themselves and go bankrupt, or not go bankrupt, but turn over as hash price is literally programmed to go down forever in BTC terms. And so as long as hash rate rises, which is, I think, a fairly good assumption given the economic incentives. So I think that's, whether it's yourself as a miner plugging in an ASIC, or just these publicly traded names, that's, a few things to consider.
Now, obviously, it's a little bit more nuanced than plugging in, unplugging, and whatnot. But we bore witness to an entire country of China turning off Bitcoin mining and saying no more. Miners just turned themselves off and then found new jurisdictions to go to. We're witnessing that right now. New York trying to pass some legislation to make mining difficult. I'm curious how much jurisdictional boundaries are being discussed out of the miners, or if that's just not something that they're sharing, that they're concerned about, or that they're paying attention to necessarily.
Yeah, I don't have too much insight there. Maybe pass it off.
Yeah, I'm not sure necessarily in terms of what they're saying, but they say a lot about where they're setting up facilities. Certainly, for sure, right? I think just when you go look at the footprints of where these things are, massive footprints in Texas, in Georgia, in other states that have just been open to policy and Bitcoin mining. So I think that's the best way to say it, is that, this is going to be one of these competitions regionally, especially in the United States, now that, I think a good thing in some ways that you have a Bitcoin mining industry that's set up to want to support kind of Bitcoin as a freedom monetary instrument, and what America is meant to be one of the best places for freedom in the world. But then even within that, in the States, you're just going to find those that are most welcome to it, in terms of jobs that they're bringing in terms of the tax revenue, tax base that they're going to bring in. So in one way, it's good to see the massive scale in the industry pushing out in North America. And I think you're going to see that essentially voting with their feet on where they're going to go, and where they're kind of looking for new projects and looking for new favorable projects. Oklahoma has been popular, North Carolina as well. And then it's really just going to be a clash of these states. I think a place like New York, if those policies continue, and some commentary I've seen from people directly in the miner space and building there is, then why do it? Why go through all those hurdles when it's going to be much easier to build operations elsewhere, especially with something that can be remote like Bitcoin mining. So I think that's probably the most interesting. I guess kind of an issue to rattle with, and thinking the decentralization of the network of we just had the latest Cambridge study come out, which there are some nuances and issues with that data, but certainly over time can see whatever way you cut that the United States is becoming more and more of the powerhouse of Bitcoin mining. So in some ways, I think that's a good thing overall for the industry. And then other ways, you're kind of decreasing that decentralization of the network on kind of a industry scale and global basis. So kind of mixed in terms of thinking, my thinking on that, but overall, generally, it looks like a lot of, whether it's, typically these have been more red conservative states or flyover states that are more open to policy or less government regulation that are promoting Bitcoin mining at scale.
I'm curious if things like, oh, I just lost my question because I now see that comment that Chris just put. um, oh, I did not read the fine print. I'm hoping you guys did. With these numbers that show the US growing its hash rate and the global share of the hash rate, is that in relation to just total like personal miners as well as like the industrial players, or is that just more focused on like the big players and the big pools? And then my follow up to that, I guess, is there genuine concern though that if like I remember when China had over 50% of the hash rate, like I was genuinely like, all right, this is where things get fucking finicky. Like if Xi Jinping is just like, hey, you know what? Bitcoin is mine now. He could have just done it. Like it could, in the same breath that he said Bitcoin mining is banned, he could have just said, I own all the Bitcoin miners. Like, truth be told, if Joe Biden wanted to do it, sure, there's some legal hurdle stepping in his way, but in theory, like, there's nothing stopping the U.S. government from saying, hey, Bitcoin miners, we now own all of you and all of the mining rigs. And what could that lead to?
I'll push back on that. I mean, I'm not a legal expert, but I think there's I don't know, even in China, like I think China, private Bitcoin miners in China, even though it is a communist country, I mean, they're some of the most innovative operators in the world, right? Like the reason why so much hash rate was in China in the first place in a communist country is because of just how capitalistic and innovative these players were. You saw, like, I saw some interesting videos post China mining ban. It was like kind of this little river in the middle of the woods, and they had two ASICs plugged into a turbine, and there's like this tiny little river, right? So I mean, obviously there's some kind of overarching power, whether it's G or maybe the U.S. government, the federal government, but I think there's also just a lot more independence and just a lot more independence and kind of bottom up innovation and capitalism than there is top down control. And that's kind of the beauty of Bitcoin. I truly don't think it's possible to get your hands on 50% of the hash rate. I just think that's out of the question at this point.
Yeah, I agree. And I think another thing is, like, even when China, banned Bitcoin mining, all the hash rate didn't leave. A lot of it went down, went quiet for a while, but they're still mining, And I think that you have to be able to find those miners. As Dylan said, people are incredibly innovative, and it's just not going to be feasible or possible to go and seize all of the physical ASICs that are operating.
Yeah, and it's a good point too. I mean, we've talked about, I guess, the data source Q was mentioned before. Kind of the one I mentioned people look at is the Cambridge Bitcoin Electricity Consumption Index. They do a regional look on where Bitcoin mining is, and that's from a sample data of mining pool partners. But there's some nuances to that too, right? Like, it is a rough view of the world, and I even think in their last release pretty much had estimated China mining share at 0 after the China mining ban. And obviously that's not correct. It's not net 0, and it's much higher than that. And I think they've tried to reincorporate some methodology to showcase that there. But there's a lot of nuance in terms of, especially with the methodology relies on a lot of IP addresses and proxy services, and it is a sample of the network, of the total network, whether it's industry scale or kind of small miner as a whole. But certainly that it's always hard to put your finger on like an exact number of what it is, but Bitcoin mining still does exist in China, and I think they've got it. I can't remember the exact number of what they have before. It's nothing like what they had, but the majority of it now just is going to continue. It seems like, from a policy perspective, to just, why would you go into an environment and build out these big production industrial scales where these industrial scale miners are becoming larger percent of the hash rate? Naturally, from competition wise, that's just going to exist in the United States. So it makes a lot of sense. The United States is just going to continue building their hash rate share as we've got some of the largest public miners in the space that are expanding out here.
Before I ask the final question, which is an audience question we received last night on Twitter, Dylan, Sam, is there anything else that we didn't touch on about the Bitcoin miners in this most recent report that you'd love to touch on?
I think that mostly covers it. I mean, we go into more detail, and there's more of the visuals in our actual issues, right? So the last one that we basically focused on today was free, right? We do have free and paid tiers. So I mean, we're sending out at least one email a week, kind of just around all things Bitcoin, macro, mining. That is free, so just check that out. Hit subscribe. You don't have to be paid, but if you enjoy it, I know a lot of people kind of start off on the free tier and then hop over because they love the content. So yeah, nothing else to add, but.
All right. Well, in that case, I'm now going to ask, in my opinion, probably the best question that anyone has ever thrown. It is written for Dylan. It is for both of you, however. And we would like to know what you feel like you need to work on / what is your weakness in your analysis, blind spot, unknowns, etc.
Yeah, I mean, I think it's partially, I mean, I'm aware that we have a Bitcoin focus. I mean, I work for a Bitcoin company, so obviously most of our thesis, for better or worse, I guess the hole in the analysis is if our broad thesis that Bitcoin's the best money ever is wrong at the end of the day. So that's most of our kind of long-term conclusions. I mean, we map out short, medium, and long-term trends with data. So we're wrong. And I guess the blind spot in the analysis is if and I think Sam and we share the same kind of end game thesis that Bitcoin's the best money ever. If that's wrong, then we're I think directionally probably that wouldn't be good. But in terms of that thesis being changed whatsoever, no, I'm still in that same belief, and I've held that belief for the last few years. So price action doesn't really mean too much in that regard. 50% off the highs is nothing, but I guess that's probably just, if I'm being being aware, self-aware, that's probably the biggest blind spot, is if we're just completely wrong and the dollar is is the best money ever.
That's like saying, like, in a job interview when someone's like, so what is your greatest weakness? And you say, well, it's just that
Hey, you gotta unmute on Spaces. Sorry.
Ah, shit. All right. I was just saying that's like in a job interview, when somebody asks you what's your greatest weakness, saying, my greatest weakness is that I'm just too strong. Too strong.
Sam, same question for you. What does Dylan need to work on in his analysis?
Oh, what does Dylan need to work on? I'll let him speak.
I'm just
savage.
I'm busting balls. What do you need to work on? What do you need to get better at?
Well, I think Dylan's point, like overarching, is definitely the biggest one, in that you always want to continually surround yourself with, when they're available, good critics of Bitcoin from all angles, because you want to be testing out. It's one thing to kind of mold your thesis around Bitcoin and align with the ideology and look at it from a market perspective and say this is growing traction and adoption and from a data-driven case. But if there's anything like the macro environment has shown us, is that you need like a full comprehensive view of not just like Bitcoin through its own lens, but how it fits in like the bigger picture as well. So that's led me to go down like a lot of analysis, and I've had a little bit of a background in macroeconomic research, but way more analysis into financial plumbing, into liquidity, into backtests of how these performed. So you kind of need to get that understanding. So when you have events like this, you're not just, necessarily writing Bitcoin off. So on the other side of that, I would say from analysis perspective is like, we cover a lot within the Bitcoin market that probably goes with macro too. And a lot of the things like today are trying to get in the weeds of Bitcoin mining, right? But you also need a good understanding, like with what we write, to be in derivatives, into on-chain, into macro. So it's really like curating a lot of your time and research to be able to try and to get some of those weeds more. And that means probably listening to a lot more smarter people than you, people who do this have a specific focus, because Bitcoin itself is, I guess you could think of it as a specific focus, but there's so much going on in the space that's hard to keep up with. So just from an analyst perspective, doing better myself and trying to carve out time to each one of those functions to kind of stay up with the most important insights that are happening.
I need to unmute myself on Spaces, but of course it goes without saying that if you're not already following these two brilliant minds on Twitter, be sure you go ahead and follow both of them. If you are not subscribed to BM Pro, like, you're just not going to make it. So I don't know. I don't even feel like talking to you. For those of you who do subscribe to BM Pro, maybe think about upgrading to the full version of it. And, as always, we appreciate both of your insights. Thank you very much. Dylan is already back to his high school final right now. So do we do a hard end, Chris? I see Alex McShane Overlord just staring at us. Brian Armstrong lookalike. Alrighty, guys. That's a wrap for today's episode. Stay humble, stack sats. It's less than 30K a Bitcoin. So, go buy some Bitcoin.
Adios.